Hello, guys. I hope you are having a good day so far. Again, my name is Joseph AGK Today, our topic of discussion will be how to, in fact, is a continuation of what we have been doing on how to evaluate a company using the content of the financial statement. So today we're going to do some evaluations. Last time we did how to calculate the free cash flow. Now, today we move a little bit further into something else that tell us a company story. That is, that tell us whether the company is a good investment with respect to buying their stock or not. I'll also explain some things about the corporate tax structure, how the corporations are taxed. US uses what they call the marginal tax system for corporate taxation. Now, let me start by sharing my screen. One more time, my name is Joseph AGK. Now, oh, I forgot to put my middle name here, AGK. Okay. Now, from like I said in my previous lecture, where after this one, the other one next that follows, we start using more evaluations that involves ratio analysis, which tells us more about a company. Now, let us, I think we can begin now. Okay, just in a few minutes, we will take off like a rocket. Today, our main focus, like I explained already, will be on more evaluation and also on the corporate tax bill, how to calculate those. The performance evaluation, we use them. In my previous lecture, I mentioned that if it is a bad sign if a company's free cash flow is negative, for the simple reason that it shows that the operating profit after tax, which are called NOPAT, which N stands for net operating profit after tax. So N stands for net, O stands for operating, P stands for profit, and A for after, and T for tax is negative, which means that the company is really experiencing some operating problems. They cannot pay their daily, they cannot handle their daily operations, financially comfortably. Now, but it's not always the case that it is negative, that it is bad when it is negative. Sometimes the company might be growing and they may be doing significant investments in different projects. That might cause the free cash flow to be negative. Then, so which means that even though it's negative, the company is still adding value. If the company is not adding value, then it's a problem. But if it is still adding value, like Amazon was doing when they have cash flow was not positive for some years, if it is adding value, eventually it will turn positive. So the thing becomes, how do we figure out if the company is actually adding value when the cash flow is negative? So to do that, what we use what we call some performance evaluation that is called return on invested capital. But before we discuss that, I want to explain the meaning of this performance. Let's show you some of the three main performance evaluations we use for checking the vital signs of a company. The first one I've already mentioned, return on invested capital. Then the market value added and the economic value added. Yeah. So we're looking at them one by one. So if the company has a negative cash flow, but it is adding value. We'll find out if we use the first one, which is return on invested capital, or any of these performance evaluations. They will tell us, oh, this company is adding value. That means the stock price will eventually rise, even though the cash flow is negative. So the return on invested capital show us how much NOPAT. When we say NOPAT, I mean net operating profit after tax. How much net NOPAT is generated by each dollar of operating capital. Again, NOPAT is net operating profit after tax. Now, so what is the criteria for using NOPAT? Well, first of all, what we do is to compare it with what we call weighted average cost of capital. So now, what weighted average cost of capital, we're going to discuss that eventually, but I want to show you briefly what it means. It means the cost of borrowing, because companies borrow money to do a project. For example, if Coca-Cola want to introduce a new brand of soda, they can sell bond or tap into their line of credit to use it to pay for research and development, and then bring out the new products, and then of course promote the products so that they can penetrate to the market. All these things requires money, and you don't want to touch the money you use for your day-to-day operations for this kind of thing. So the company, what most companies normally do is to tap into your line of credit, or sell bonds, or take a long-term debt to fund these projects. Then as the projects start generating cash flow, they'll take care of the debt. So why do we call it weighted average cost of capital? Because it is basically what it is, the weighted average, which I'm going to show you in a brief. Just let me see if I can use this section. I think I can use it. Okay. Suppose we have this this company that have. I'm going to add a new sheet here so you can use it. Okay. Have this company. So let's say this is the debt, type of debt that they have, and the weight, what percentage of the company's debt is this, and the cost. Okay. So let's say this one is, we have commercial papers, bonds. Okay. So that means 20% of their debt. Let's say 20% is from bond, 20%. And the cost is, that means the interest they pay the lenders for this. The borrow lenders will be, let's say it's 2%. And then line of credit that they got from the bank. Okay. So let's say that it is 50% of the debt that they have. Okay, we say 50%. And then the cost is 3% or 5%. Then the balance left that is 30%, which is, this is commercial papers. Okay. Okay, we say commercial papers is 30%. And the rate, interest they pay is 3%. So now, the weighted average of this debt, that's what we call the weighted average cost of capital. Okay. So back to our main topic. So the return on invested capital, we'll calculate it. We compare it with the weighted average cost of capital. If it is bigger than the weighted average cost of capital, it means that the company is adding value, even though the cash flow is negative. If it is smaller, that means the company is not adding value, which implies that the negative cash flow actually indicates real problem. So that will make you to start digging more to see what is wrong, and then see if you can bail out of the company or not put your money there. Okay. Now let's look at, remember we are using the financial statement that belongs to this company. Excuse me. That belongs to this company, Dominion Plastic Incorporated. Excuse me. I think I'm going to see the balance sheet is right here. You can see the balance sheet. The income statement is for here. Okay. So these are the two financial statements we're using for this company. So let us see if this company is returning value. Last week, we calculated the free cash flow for this company, and I found that it is negative. So let's see if it's adding value. Okay. Now, based on what I have just explained, the computational formula for return on invested capital is as follows. Have it here. No part, which is net operating profit after tax divided by operating capital. That's the formula. So let's see. We calculate the Dominion Plastics return on invested capital using the formula that I just explained. Let us assume that the tax rate is 40% and the weighted average cost of capital is 11%. So EBIT, first thing to get a no part, we use earning before interest and taxes times 1 minus tax rate. So if you look at the income statement, you can see that EBIT is right here. So no part, we have it here calculated. Tax rate is 4% and 4%. Let me make this a little bit bigger. So tax rate is 40% and 40%. So that no part will be, I've already calculated it here, but I want to show you so you can see how I got it, right? Okay. So we calculated last week when we were doing the cash. So you have equals earning before interest and taxes, which is right here. Click on that. Times, okay, 1 minus, you can see the work here. It's showing here. And the tax rate is 40%. Click, you can see that it shows here. And then we close the parenthesis. It also shows here. The work also shows here. So 2 places. So you can see 300 million. You can see right here. I have the same result here and here. Okay. Now, if you copy it to the next page, the next cell, to calculate for the year 2000, because this one is year 2020, this is 2021. So we copy it to calculate the same for 2020, which is what you have here. Okay. Now, so since we have it already, you can see how it's calculated. So, and I have the same thing in in the PowerPoint. You can see right here, 500 million times 1 minus 0.4, which is 300. So now, next thing we need to get is the operating capital, which is the total net operating capital. The formula is net operating working capital plus operating long-term assets. Now, for our Dominion Plastics data, we have the net operating working capital as 1050 million, okay? And then the operating long-term assets is this. So it's 2000, 2000 million. Now, so the net operating profit after tax, net operating capital or operating capital, just per se, it just equals, you add this to this. I'll make sure you're seeing this. Okay, good. Okay. Plus, okay, I think I missed it. Plus the operating long-term assets. And that gives us 3050. Okay. Now you copy it to the next cell. It will calculate for the previous year, which is 2020. Now, with this, we can now calculate our what we needed is the what we needed is the return on invested capital, which is NOPAT divided by operating capital. Okay, so let's do it. So that's the return on invested capital. Return on invested capital year 2021. So it's gonna be equals NOPAT. If you remember the formula, okay, the formula says NOPAT over operating capital. So we have it equals to NOPAT is right here. NOPAT again, like I explained, is net operating profit after tax. Is this divided by total net operating capital, or just you can just call it operating capital. And that gives us 0.098, which you can change it to percent. If you like, you can format cell and then call it percent. See, which is I'm gonna highlight it. Okay, I'm gonna highlight it. Okay, so like I said, these numbers present, if you make it percent, you can always make it straight from here. Right? I needed it to have 3 decimal places. So in 2021, it has the 9.84%, but the weighted average cost of capital, like according to the question, the weighted average cost of capital, if you look at the question, the cost of borrowing is 11%. And then the return on invested capital is 9.83%, which we can find, we can see from our calculation. So 11%, 11%, and 11%. So this is how much the company is returning, but it is owing 11% in debt. So it's not making money, sorry. It's not adding value, because what is returning is not even enough to pay its debt. See? So that is a first red signal, red light, or red line, what they call it. That's alarm that something is wrong. I'm sure you get the concept. So that is basically how we use the return on this performance evaluation called return on invested capital to evaluate a company. I'm sure you're having fun on this. So next evaluation. Remember, there are 3 of them that I mentioned. Next one is market value added. Market value added basically is the difference between the current market value of the company, okay, and the capital contributed by the investors. So if I call it the MVA, if the MVA is positive, the company is adding value or added value. And the MVA is negative, the company destroyed value. Now, before I calculate it, I want to show you something from their previous calculation for return on invested capital. You can see that in year 2020, this company added value because it is bringing in 13.25%, but the cost of capital is 11%. So it added value in 2020, but destroyed value in 2021. So, because it has a negative cash flow that year, and other factors that we may not know. Now, anyway, back to our current metric. So the formula for the market value added is market value of the stock, or what we call market capitalization, minus invested capital. Excuse me. So for the market capitalization, we use shares outstanding times the stock price for that to represent market value. And then for the invested capital, we use the total common equity. So it becomes share outstanding times stock price minus total common equity. So let's try it for our company, Dominant Plastics. It says that it has 50 million shares. When you look at the balance sheet of this company, look at the balance sheet. Okay, so I'm going to make it bigger. So you will see that when you come to the equity section, you can see that it has 50 million shares. Common shares, I mean to say. Now the price per share, that one you can see from the income statement. Per share price, you can see stock price per share. You can see right here. It was $40 per share in 2020, but $27 per share in 2021. Okay. So next is the other part, which is the total common equity. For that, we're gonna use the total common equity. You're gonna look if you can find it for the balance sheet. And the total common equity will be let's look at the balance sheet. So I'm gonna put, first of all, let us put the share price. Oh, I think we better do it on the end balance sheet. Okay. The share price is I'm gonna copy it from the income statement. I have share price. Stock price per share is this. So let me just copy this. And you know what? I'm gonna stock price per share. Let me copy just this one. Stock price per share. Okay, I put it in balance sheet right here. Paste it. Make sure you choose numbers. So this is our stock price per shares. Share. And next thing we need is the stock price. Okay, share outstanding. That we already have here in the balance sheet. Stock outstanding. See 50 million shares. See 50 million shares. So you can see 50 million shares stock outstanding. Just give me 1 minute. Let me produce this. Yep. Total common equity. Because everything is million. 50 million shares. Stock outstanding, shares outstanding 50 million. Okay. Outstanding. They have 50 million shares. Now, next thing part of the formula we need is the total common equity, I believe. It's called total common equity. So our total common equity is right there in the balance sheet. Total common equity. You can see it in the balance sheet. You can see total common equity. See, right here already. So in that case, you can calculate the MVA. MVA, which is the excuse me, the money, but the market value added, MVA. So market value added, maybe, excuse me, I click on the wrong thing. Okay. So market value added, which I call MVA. will be equals. So again, the formula is this price per share times shares outstanding minus the total common equity. So all these things are in millions of dollars. So it's negative. It's positive in 2020, but negative in 2021. So if this all these things are this one is money. I can just make it currency right here. Let's see. Why not? So it indicates trouble like the other one. So I'm glad I'm sure you are understanding this. Now the last evaluation that we're going to be using is the economic value added. So before that, let us comment on our results here. So we have negative 120 million, which means that Dominion Plastics actually destroyed value in 2021. Its current market value is less than the cumulative amount of equity that its shareholders invested. So now we now move to the next evaluation measure, which is the economic value added. So this one measures the extent to which the firm has increased shareholder value again. So these are value metrics. The formula is NOPAT minus total net operating capital times weighted average cost of capital. So, so we have total net operating capital. So we have it as 300 million for this company. If you look at the income statement, so we have total net operating capital income statement. NOPAT, net operating profit after tax is 300 million. Now, next thing is the what we have, which is the weighted average cost of capital is 11%. Total net operating capital, we have it there. So that let me put the formula down so that I can, when I move here, we will not be able to see it. So it's going to be part minus total net operating. Okay, I think I can have it here. So you're going to be okay. Total net operating. Just a minute. Let me pull this out. Okay. Total net operating capital. Now we have a column for like this down. Okay. All right. Let's do the calculations. Have economic value added plus NOPAT minus total net operating capital times weighted average cost of capital. So you can have it here as economic value added. Economic value added. ECV, EVC, EVA, sorry, EVA. B equals NOPAT, which is net operating profit after tax, minus total net operating capital right here, times the cost of capital. Now, I have to change the cost of capital to decimal because if you are using the place the way it is written here, it will overestimate the value. So I'm gonna all over on that. So make this 0.11, that means 11%. I have to reformat this section to numbers. Numbers. Okay. 0.11 here, which is the cost of capital. Okay. Look at that cell is corrupted, so I'm going to use this cell. The average cost of capital. 0.11. 0.11. Okay. Now, the economic value added now becomes equals have no part, which is this here. See no part, which is net operating profit after taxes. Minus have total net operating capital, which from here. Okay. Times the tax. Okay, close it. See, negative give us negative 35 million. So it added value here, but it destroyed value here because it's negative. That's why it's in parentheses. And when you look at the PowerPoint that we have, you will see that we have the same result. Say 300 minus 30, 50 times 0.1. That will give us 30. So now this value shows that again that the it basically reinforces our conclusion that aluminum plastics is having problems, at least in the year 2021. So that's basically explain these three evaluation measures. Now we can now turn our attention to the next thing that we have today, which is the federal income tax system, for corporate taxes, company taxes. So now I know I mentioned that the value of financial assets depend on the cash, how much positive cash flow it can bring in over the years. Now, the value of financial assets, when I say financial assets, I also mean stocks and bonds and commercial papers and so on. So their value depends also on the real assets, on the real after-tax stream of cash flows are produced by, that they can produce after tax. So if it's positive, it's good. Negative, not good. Okay. Now, but which brings us to the tax structure, tax system that the US uses. US uses marginal tax system. Marginal tax basically tax any additional increment in income. So it is the rate, amount of additional tax for every additional dollar earned as income. Of course, the average tax rate is just tax due divided by taxable income. So let me make sure you are seeing this. Okay, good, you're seeing it. Now, let's look at the federal income tax as the way the percentages. Well, let me say the schedule or the table. For the first 15% tax on the first $50,000. Then for any additional income of 25,000, you have 25% tax on that. For an additional 25,000, you have 35% tax on that. For additional 235,000, you have 39% on tax. So the tax keep going up, increasing, and so on and so forth. Let us see how we can use this to calculate the tax bill of a company. Look at this company. It says Went Corporation has 10.5 million. Just 1 minute. Yep, you have it. 10.5 million of taxable income. What is the company's federal income tax bill for the year? So I'm going to do this in Excel. We put in all this information. That's for the first 50,000 is 15%. For the next 25,000, you'll be taxed 25% on that $25,000 increase. So on that marginal increase, that's the tax next tax will be applied, not on the entire tax income. So I'm going to put this all the way to the income level that it allows. So look at the table here. I'll share this. So the tax, let's see. Tax bill. Now I'm gonna make it bigger. Excuse me. And this company makes how much does it makes? Let me see. It makes 10.5 million. So we start from the structure here. For the first 50,000, it will tax 15%. For the next 25,000, it will tax 25% on that extra 25,000. So and so on and so forth. So that means we follow it right here until we have all their money that they make. So the first 50,000, it has this. Next 25,000, 25%. Next 25,000, 34%. 250,000, 39%. 966,500 is 34%. Now, and of course, the last amount. So if you look at this, you can see that from here, you add all of this. Okay. From here to this place. Okay. And it will equal sum. Okay, let's see. That's 5. Now, if you add this, let me do all of them. Sum. Okay. All the way to this one here. Okay, you see that it is it's giving me a large number, so I know why it is like that. Let me see 1 million. I mean 10 million. Let me make it dollar sign. It's 10 million. So how much is left on this? I'm going to change all this to currency so that you can calculate it better. See, so how much is left from 10.5 million is 500. So now you can see that the 50,000 you're going to tax for 15%. Next 55,000, which will be extra money on top of 50, which is 25, so making it 75,000. But you will not be taxed on the 75,000. You'll be taxed on the extra 25,000, which is, and it will be taxed at the rate of 25%. Now the next 25,000 will be taxed at the rate of 34%. Then followed by 35,000, you'll be taxed at the rate of 39%. Then an increase. So that total bill, they'll be taking tax for each additional more income you earn until the last one. After this one, what is left of the 10.5 million is only 500,000. Then it will be taxed at this amount at 5%. So let's calculate the total tax bill. First of all, let's calculate the tax bill for each section. Equals this times this. Of course, in Excel, you already know that the asterisk symbol here represents the tax multiplication. So, and then you copy it all the way down, or you can double click at this box here, so that the total equals sum. Okay. Okay, copy all of them and close it. See, 3.575 million. That's the tax bill. And if you look at the PowerPoint, you see that I got the same thing. That's right here, 3,575,000, or you can call it 3.575 million. So that's how the tax bill, marginal tax, is calculated. Now, I hope you enjoyed the lecture. In my next lecture, like I say, other subsequent one, we can now begin to do more analysis on the financial statement, things like the ratio analysis, and so on and so forth. Again, my name is Joseph Ejikeoji, and I thank you for listening. I wish you a good day. Okay, bye-bye. And I hope to see you in my subsequent lectures. Okay, bye-bye.